What last 90 days of Goldman Sachs buy ratings? Tell us about midcap conviction by value and momentum portfolio. Every quarter, I run the same unglamorous exercise. I filter the analyst tape for fresh Goldman Sachs buy ratings. Then I narrow it to the midcap band. Companies worth between $1 billion and $20 billion. And I see what falls out. Midcaps are where I spend most of my attention now. They're large enough to have a real operating history and a defensible balance sheet, but they're small enough that the franchise still has a long runway to reinvest and grow. It's the part of the market where genuine compounding either announces itself or quietly fails to. This quarter, the bank was Goldman Sachs. The window was the trailing 3 months ending June 2nd, 2026, and the result was almost comically thin. The whole data set surfaced just 3 tickers with a Goldman buy attached. The first was Hawkeye 360, ticker Hawk. Goldman initiated coverage at buy on June 1st with a $42 price target. Market cap about $2.95 billion. The second was Mobia Medical, ticker MOBI. Initiated at buy on June 2nd, $31 target. Market cap $447 million. And the third was Neurocrine Biosciences, ticker NBIX. Goldman reinstated coverage at buy on June 2nd with a $213 target. Market cap around $16.2 billion. 3 names in 90 days, that's the whole list. And as you'll see, the silence is the story. Now, 2 of those 3, Hawk and Mobi, were initiated this week as brand new coverage. No earnings history, no 10K, no fundamentals to speak of. They're recent listings. And that single fact explains almost everything about how you should read their ratings. Here's what happens when a company goes public. The banks that ran the IPO usually wait out a quiet period. Then they initiate coverage in a coordinated cluster, often at buy, often within days of each other. I think of this as the underwriter's halo. It's a burst of favorable research, and it says less about the business's fundamentals than about who got paid to bring it public. It isn't fraud. It isn't worthless, but a wall of same-week buys from the deal's own syndicate is a structural feature of the IPO machine. It is not independent confirmation of value. The signal you actually want is the dissent. The firm's willing to put a hold on a fresh name. Hawkeye 360. Let's start with Hawkeye 360. Last price $29.59. Market cap around $2.9 billion. So what does it do? Hawkeye is a radio frequency geospatial intelligence company. It runs a satellite constellation that detects, characterizes, and geolocates radio signals anywhere on Earth. Think about spotting a vessel that has switched off its transponder, or mapping electronic activity across a region. Its customers sit in defense, maritime, and government intelligence. And there are no earnings yet. The coverage that landed on June 1st looked like this. Goldman Sachs at buy, $42. Morgan Stanley at buy, $41. Baird at buy, $41. RBC Capital at buy, $40. William Blair at buy, no target listed, and then 2 holds, Bank of America at $34 and Jefferies at $34. So that's 5 buys and 2 holds. Goldman is the high mark at $42. Roughly 42% upside versus that $29.59 last price. The only operational news of note is a $125 million revolving credit facility signed on May 21st. And the broader tape has space sector names catching a bid on SpaceX IPO momentum. But here's the detail that should slow you down. The stock at $29.59 is trading below every single price target on the sheet, including the 2 holds at $34. The market is pricing this name beneath where even the cautious analysts say fair value sits. That's either an opportunity the tape hasn't woken up to, or the tape knows something the freshly minted models don't. And with no fundamentals to settle the disagreement, you're trading a thesis, not a business. So the honest bull case, real defense and intelligence demand, a genuinely niche moat in satellite RF, a strong multi-firm consensus, and Goldman carrying the highest target on the street. The honest bear case, 0 earnings history, a price already trailing the entire target range, and 2 of the 7 covering banks choosing caution out of the gate. Mobia Medical. Now to Mobia Medical. This is the most speculative of the 3, and it isn't close. Last price, $13.72. Market cap, about $447 million. It's a recently listed medical device company. No SEC 10K yet. And that $447 million market cap puts it well below the mid-cap band. This is a small cap, full stop. Its June 2nd coverage was a clean sweep. Goldman Sachs at buy, $31. BTIG at buy, $19. Bank of America at buy, $16. And JP Morgan at buy, $15. 4 firms, 4 buys. That's unusual unanimity, but look at the targets. They run from $15 all the way up to $31. Goldman's $31 implies a startling 126% upside against the $13.72 last price. Think about what that spread is telling you. When 4 analysts agree on the direction, but disagree by more than 2 to 1 on the destination, that isn't conviction. It's 4 people admitting they can't yet value the thing. The spread is the message. The honest bull case, a 100% buy consensus across 4 banks, Goldman as the highest conviction name of the 3, and a clear runway to target if the device franchise executes. The honest bear case, a tiny float, a price target dispersion that screams uncertainty, no financials to underwrite, and the binary risk that small-cap medical devices always carry. Regulatory and commercial outcomes that tend to be all or nothing. For a quality-oriented book, Mobi is a watch-and-learn name, not a position. There is nothing here yet to compound. NBIX, the one that qualifies. So strip away the 2-story stocks, and you're left with a single name that has a real operating track record, a real balance sheet, and a genuine claim on the midcap label. Neurocrine Biosciences, ticker NBIX, trading at $155.40 with a market cap that has firmed to around $16.2 billion. Goldman reinstated coverage at buy with a $213 target on June 2nd. This is the name worth dwelling on, because it's almost a textbook specimen for the framework I keep coming back to. So let me walk it through the way I'd evaluate any compounder. Start with the business. Neurocrine is a CNS-focused biopharma that's central nervous system disorders. 2 products carry the franchise today. The first is Ingrezza. It did $2.51 billion in 2025 revenue, treating tardive dyskinesia and Huntington's chorea. This is the engine. The second is Crenessity, a newer launch, $301 million in its first full year, for congenital adrenal hyperplasia. And behind them sits a pipeline with 2 phase 3 programs reading out in 2027. Osavampator for major depressive disorder, and Diracladine for schizophrenia. Those 2027 data sets are the next major fork in the road, pure binary catalysts. They'll either extend the runway dramatically or close a door. Now the quality test. This is where NBIX earns its place. Look at the Q4 2025 fundamentals. Gross margin, 97.8%. Free cash flow in that single quarter, $442.7 million, and total debt, none reported. Read those 3 lines again. A 97.8% gross margin, over $442 million of free cash flow in 1 quarter, and 0 debt. That is the financial signature of a high-quality franchise. The pricing power and capital-light economics that let a business turn revenue into cash at extraordinary rates and reinvest from a position of strength, not need. The rest of the picture fills in around that. Price to earnings, 33 times. Price to sales, 5.3 times. EV to EBITDA, 22.3 times. Net margin, 19.1%. Those multiples aren't cheap, but they're the price of admission for that quality, not a bubble. Now the earnings trajectory, because the recent print tells a recovery story. In Q4 2025, the company earned $1.88 a share against a $2.09 estimate. That's a 10% miss. But revenue still came in at $805.5 million, ahead of the $786.7 million estimate. Then Q1 2026 snapped back hard. Earnings of 1.94 a share against a 1.61 estimate, a beat of 20.5%. Revenue of $814.5 million, up 42% year over year. Notice the texture. Even in the disappointing quarter, revenue still beat. The miss was on earnings. A cost and timing story, not a demand story. And the Q1 snapback suggests the top line was never the problem, and the street is leaning in. Over the trailing 3 months, NBIX drew 19 analyst ratings, 17 buys, 2 holds, targets spanning $155 to $246. Goldman's reinstated $213 sits comfortably in the upper half. Bernstein initiated at $221. Unlike Hawk and Moby, this is an independent chorus. Not an underwriter's halo, a deep bench of analysts looking at years of actual financials and arriving at the same place. But a quality screen is only honest if it takes the risks seriously, and NBIX's risks are real. First, the patent cliff on Ingrezza. Generics are permitted from 2038, or potentially earlier under certain conditions. The crown jewel has a clock on it, even if it's a distant one. Second, drug pricing risk under the Inflation Reduction Act. Medicare can now negotiate prices directly on selected high-spend drugs. That mechanism didn't exist a few years ago, and it compresses margins on the drugs it touches. Ingrezza could be exposed after 2029. For a franchise this dependent on one product, that's a structural headwind worth modeling, not waving away. Third, there's an open DOJ civil investigation into Ingrezza's sales and marketing practices, a legal overhang with an uncertain outcome. Fourth, customer concentration. Per the 10K, roughly 4 customers account for more than 90% of gross sales. That's typical for pharma distribution, but on paper, it's still a fragile-looking dependency. And fifth, that 2027 pipeline. Those readouts cut both ways. Then there's the insider signal. Through May 2026, multiple directors sold into the open market. Gorman sold $37.8 million, Pops $2.4 million, and the chief scientific officer, Onyia, $1.7 million. No insider buys on record. Now, insider selling after a strong run is common. Often it means nothing more than diversification or scheduled liquidity. But a clean tape of sells with not a single buy is worth filing away, particularly with a DOJ matter outstanding. I'd call it a yellow flag, not a red one. So the honest bull case on NBIX, a dominant position in tardive dyskinesia, 98% gross margins, 0 debt, $443 million in quarterly free cash flow, a strong Q1 beat, a pipeline with 2027 catalysts, and 17 of 19 analysts bullish. The honest bear case, persistent insider selling, the DOJ investigation, IRA pricing exposure on the biggest product, and a stock sitting at the very bottom of its analyst target range, $155 against a range of $155 to $246. That last point is the one I'd underline. NBIX is trading at the floor of where the street thinks it belongs. If you believe the quality is real and the bear cases are manageable, that's a setup worth understanding. If you think the overhangs are about to bite, the market is simply early in pricing them. The takeaway. So let's bring it home. 3 buy ratings in 90 days, and the most useful thing the screen produced was a lesson in how to read them. 2 of the 3, Hawk and Moby, are fresh listings wearing the underwriter's halo. A same-week buy consensus that tells you more about the IPO syndicate than about the business. They're stories, and stories can pay off spectacularly or evaporate. What they can't do yet is compound, because there's no demonstrated cash engine to compound. Hawk at least has a defensible niche and a defense tailwind. Moby is a lottery ticket with a wide spread on the prize. Only NBIX clears the bar a quality investor actually cares about. A real franchise, near-perfect gross margins, no debt, hundreds of millions in quarterly free cash flow, and a street that's overwhelmingly long. It also carries a stack of legitimate overhangs, IRA pricing, the DOJ probe, insider selling, that 2038 patent clock. And those are precisely the kind of risk the multiple has to keep digesting. Here's the cleanest way I can frame it. Hawk and Moby ask you to believe a narrative. NBIX asks you to underwrite a known set of risks against a proven cash machine. Those are fundamentally different bets. And conflating them just because the same logo printed buy on all three is exactly the mistake the screen is designed to expose. Goldman went quiet this quarter, and the one place the silence broke cleanly is also the one place there was a real business underneath it. That's not a coincidence. Quality is rare, and it's rarely loud. Quick reminder before we wrap. Everything in this episode is for informational purposes only. It is not financial advice, and it's not a recommendation to buy or sell anything. I may hold positions in the names discussed. Investing carries real risk, and past performance never guarantees future results. Do your own due diligence, or talk to a licensed professional before you act on anything you heard here. All of this is sourced from public filings, current as of June 3rd, 2026. I'm Dennis, and this is the Value and Momentum Portfolio. Sell-side rigor brought to U.S. and international midcaps, paired with high-conviction momentum setups. Thanks for listening. I'll see you next time.